Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. The calendar says January 8th, 2026, and, the global economy is being pulled in two vastly different directions right now.
They feel different, but they're so deeply interconnected.
Exactly. On one side, you've got this relentless, almost dizzying acceleration of artificial intelligence, and on the other, a geopolitical risk profile that seems to be getting more complex by the hour.
Right. So our mission today for you is to really dig into that. We've pulled the sharpest analysis from our stack of sources. We're looking at Bloomberg, Reuters, Yahoo Finance, and CNBC to give you those strategic takeaways.
We've distilled it all down into, what, three big interlocking narratives?
That's right. First, we're going to tackle the intensifying AI hardware race. The announcements out of CES 2026 have been huge, and they're already causing these dramatic shifts among the biggest tech players.
Even the Magnificent Seven.
Especially the Magnificent Seven.
Then we're going to zoom out. We'll look at how global instability is hitting resource allocation, energy markets. We'll cover the huge geopolitical play happening with Venezuelan oil, the whiplash in defense stocks, and a critical shortage of copper that, frankly, could threaten this whole tech boom.
And finally, we tie it all back to the money to capital. We'll examine the unprecedented pace of corporate bond issuance we're seeing and the high-stakes regulatory battles that are pitting giants like Apple and Meta against some really powerful governments.
Okay, let's unpack this starting in Las Vegas. The Consumer Electronics Show, CES 2026, it just wrapped up. And according to every report we read, especially from Yahoo Finance, it wasn't a trade show, it was a battlefield.
A chip war for AI dominance. Absolutely. It was just AI saturation.
Everywhere.
Pure and simple. You couldn't walk the floor without seeing AI plastered on everything. We saw AI PCs, smartphones, wearables, even AI-integrated toilets.
So it's officially left the data center.
Oh yeah, it has fully arrived in the consumer conversation. And the speed at which the industry is turning over this hardware generation is just, it's astonishing.
And that speed, it's all dictated by the hardware, right? The biggest news, of course, came from NVIDIA. Their dominance is constantly being challenged by their own innovation.
Indeed. On January 5th, CEO Jensen Huang got up and unveiled the Vera Rubin platform. And this isn't just a new chip, it's a massive integrated system.
The whole stack.
The whole stack. You've got the Vera CPU, the Rubin GPU, and then 4 other specialized chips for networking and storage. The numbers they are claiming are staggering. They immediately set a new benchmark for the whole industry.
So specifically, they're talking about a 10x improvement in throughput and a 10x reduction in something called token costs compared to their Grace Blackwell platform, which is already top of the line.
Let's pause on that second number, because for anyone focused on the economics of running AI, that cost reduction is just crucial.
Explain that a bit more. What are token costs?
So when we talk about tokens in the AI context, you're talking about the basic variable operating expense of running those massive models. Every single word, every piece of data the AI processes or generates, that's a token.
Right.
If you can reduce the cost of that process by 90%, which is what a 10x reduction is, you suddenly make deploying AI infinitely more affordable and scalable for big companies. It's a huge economic incentive that guarantees faster adoption.
And the competition, they hear those claims loud and clear. This isn't just an NVIDIA show anymore.
Not at all. AMD CEO Lisa Su was out there, pushing their new AI PC chips. Intel is launching its Core Ultra Series 3 processors.
Qualcomm, too.
And Qualcomm with its Snapdragon X Plus 2 chip.
Yeah.
So as Yahoo Finance is reporting, this sets up a fierce three-way fight just for that specialized AI PC market. The bet is that you, the consumer, will pay a premium for localized, instant AI power right on your device.
Speaking of high stakes, Reuters detailed a really fascinating risk management strategy from NVIDIA. It's all about their China business, which is, highly sensitive because of U.S. export controls.
This is a masterclass in financial risk transfer. To insulate themselves from that geopolitical uncertainty, NVIDIA is now requiring full upfront payment for its H200 AI chips from all its Chinese customers.
And the key part.
The key part is 0 options for cancellation or refunds, no matter what new regulation might come down from Washington or Beijing.
So they're putting the entire regulatory risk squarely on the customer. Why now?
Because demand is just so far ahead of supply, especially in China. We know Chinese firms have ordered over 2 million H200 chips.
Wow.
But NVIDIA's reported inventory is only around 700,000. So by demanding payment now, they lock in that revenue, regardless of whether a future policy change forces them to halt shipments. It just minimizes their exposure.
Okay, now let's talk about the corporate front, this Magnificent Seven shuffle, because the market is already rewarding the quick movers in this race.
It absolutely is.
Reports from CNBC and Yahoo Finance confirmed that Alphabet, Google's parent company, has officially overtaken Apple in market cap. It's the first time since 2019.
And the numbers are close, but symbolic. Alphabet's now at about $3.89 trillion, just edging out Apple's $3.85 trillion.
This feels like a profound market judgment.
It is, plain and simple. This isn't just a simple shift in rank. The market is voting with its dollars that Apple is lagging in the definitive technology battle of this decade.
The AI arms race.
Exactly. Alphabet's rapid deployment of its new AI, Gemini 3, which they're already putting into consumer products like Google TV, that's winning investor confidence. Meanwhile, Apple's big overhaul of Siri is still delayed. Speed is everything here.
And you saw that in the stock performance last year.
Oh yeah. Alphabet was the best performing big tech stock, up 65%. That momentum is clearly carrying forward.
And the ripple effects of all this chip demand are immense. It's not just the stock prices, it's the entire supply chain.
Right. The need for AI infrastructure is driving massive tangible profits down the stack. We saw reports from Bloomberg and CNBC that Samsung Electronics is projecting its Q4 2025 operating profit to triple to a whopping $20 trillion, which is about $13.8 billion. And that surge is a direct result of skyrocketing memory chip prices. DRAM is up over 30%, NAND is up 20%, all driven by this intense demand for AI servers.
And before we move on, we have to acknowledge AI is moving into our physical world, and fast. NVIDIA unveiled Alpamayo, which is an AI reasoning model for self-driving cars.
And this isn't just about detecting objects. It's designed to understand unique, sudden situations. Complex reasoning like identifying a child chasing a ball into the street. It's a huge step up.
And then there are the robots.
Can't forget the robots. Hyundai and Boston Dynamics are planning to mass-produce humanoid robots by 2028, deploying the Atlas bot in factories. That moves AI from a service into physical labor, a massive leap.
And one quick note on health. OpenAI launched ChatGPT Health. It lets you connect medical records and wellness apps.
But they were very clear. This is not for diagnosis, and your data won't be used for model training. The aim, though, is pretty clear: to be a personal super assistant for your health data. That's asking for a lot of trust.
Okay, so this whole AI race demands massive compute power, colossal infrastructure. But where do you get the raw materials and stable resources for that? And that's where the geopolitical chessboard really comes into play.
It really does.
Shifting focus now, we see global instability having an immediate, profound effect on energy and commodities.
And the biggest maneuver this week is all about Venezuela, following the deposing of President Nicolas Maduro. According to CNBC and Yahoo Finance, U.S. President Trump announced a transfer of 30 to 50 million barrels of crude oil to the U.S.,
which is an immediate supply injection worth over $2 billion.
It's a significant volume, but the real story is the extraordinary control mechanism they put in place.
Right. U.S. Energy Secretary Chris Wright confirmed the U.S. will control Venezuela's oil sales indefinitely. But there's a strategic kicker, isn't there?
There is, and it turns this whole thing into a massive geopolitical lever. The revenue from these sales has to be deposited in U.S. accounts, and Venezuela is only permitted to purchase American-made products with those funds.
Things like agricultural products, medicine.
Exactly, and equipment for their energy grid. This is more than just an oil transfer. It's the U.S. basically running Venezuela's national oil policy and currency flow. It supports its own domestic industries by creating a massive captive buyer.
And for investors, the market reaction was immediate.
Obvious. Oil prices dropped overnight on the prospect of more global supply. But the long-term political implications of that kind of economic control are just immense.
We saw a similar kind of whiplash in defense stocks this week. It really proves how reactive the sector is to political rhetoric.
It really does. Initially, U.S. defense stocks fell hard after President Trump threatened to ban stock buybacks and dividends.
Right, until firms addressed complaints about executive pay and production speed.
But that dip lasted about a day. Then momentum reversed completely. Global defense stocks rallied sharply after Trump called for a monumental $1.5 trillion military budget for 2027.
A 50% increase from the previously proposed $1 trillion budget.
A huge increase. CNBC reported major U.S. defense names surged: Northrop Grumman up 6.8%, Lockheed Martin up 6.7%. When the budget proposal is that much larger, the threat of banning buybacks just becomes a secondary concern.
So if we connect the dots here, between the huge defense buildup and the accelerating AI infrastructure demand, we get to a critical bottleneck.
A bottleneck that underlies this entire global boom. Copper. The physical demands of the digital world are restraining raw material supply.
This feels like a looming crisis spot.
It is. S&P Global highlighted this in reports covered by Bloomberg and Yahoo Finance. They're forecasting a critical global copper shortage driven by the sheer scale of these simultaneous booms, AI, data centers, and global defense. The timeframes are alarming.
How critical are we talking? What are the numbers on the supply gap?
So global demand is projected to rise 50% by 2040 to about 42 million metric tons. Production, however, is expected to peak around 33 million tons by 2030.
That leaves a massive gap.
A 10 million ton supply gap by 2040. And here's the crucial part. S&P's modeling shows that even if global copper recycling rates double, which is a huge technological hurdle, that gap remains devastatingly large. We are running up against hard physical limits.
And how much of that spike is purely from AI and defense?
The analysis projects that demand from just those sectors will roughly triple by 2040, adding about 4 million tons of consumption. And here's a detail I found fascinating from S&P Global.
Go on.
They estimate that if we hit the projection of 1 billion humanoid robots operating by 2040, that robotic workforce alone would require 1.6 million metric tons of copper every year.
Wow. It's a stark reminder that the future is digital, but it runs on very finite, very heavy metal.
Exactly.
So that transition from silicon and copper brings us to how capital is moving to finance this new reality. Let's look at the financial plumbing.
Right. According to Bloomberg, the global bond market has started 2026 with historic volume. Global corporate and government bond sales hit an all-time record of $260 billion in just the first few days of the year.
That's an incredible pace. Why the rush to issue so much debt right now?
It's highly strategic. Issuers are seizing on tight credit spreads and really robust investor demand to lock in attractive funding early. When we say tight credit spreads, we just mean the risk premium investors' demand is low right now, making it cheap to issue debt.
And for those tech giants and governments looking to fund the huge AI and military expansions we just discussed, this is the perfect time to build a war chest.
Absolutely. We saw chipmaker Broadcom raising $4.5 billion, French telecom Orange raising $6 billion. That scale signals a huge appetite for cash to fund these next-generation projects.
Meanwhile, the IPO market in Asia is surging, with Beijing strategically prioritizing its own tech listings.
That's right. Reuters and CNBC reported that China is fast-tracking approvals for AI and semiconductor companies to strengthen their domestic alternatives. We saw Zhipu, one of China's AI tigers, rise as much as 15% in its Hong Kong debut.
And Zhipu is the first major Chinese large language model developer to go public, right?
It is. It signals Beijing's explicit strategic support. We also saw Omnivision Integrated Circuits raise over $600 million.
Okay, moving to corporate deals. There was a major transaction that marks the end of an era for Goldman Sachs.
The Apple Card saga is officially over. JP Morgan Chase reached a massive deal to take over the portfolio, acquiring over $20 billion in loans from Goldman.
So Goldman is officially out of the consumer finance game.
They are. It had become a significant loss-making headache for them. For JPM, this just grows their already massive footprint as the country's largest card issuer.
But the fine print here reveals the risk JPM is taking on.
It does. JPM is taking a substantial $2.2 billion provision for credit losses. They are essentially taking a massive calculated hit up front.
So what does that tell you?
It tells us that the subprime exposure in that Apple Card portfolio, the exact risk Goldman was happy to get rid of, is substantial. JPM is buying volume, but they are pricing in some significant anticipated defaults.
Finally, let's look at the regulatory friction that's cropping up for these big tech giants.
Two great examples here. First, according to Reuters, Apple is fighting a 2024 Indian antitrust law. This law lets India's watchdog calculate fines based on a company's global turnover, not just its revenue within India.
And Apple's argument is that could lead to these hugely disproportionate fines, right? They're fearing exposure up to $38 billion.
Correct. But India's watchdog counters that a global basis is necessary to maintain a real financial deterrent for these massive multinational firms.
And then there's China tightening its grip on valuable AI assets.
That's the meta story from CNBC. China's Ministry of Commerce is probing Meta's $2 billion acquisition of an AI startup called Manus.
Which is based in Singapore, but it originated in China.
That's the critical part.
Right.
The probe is looking into compliance with China's export controls, basically underlining that Beijing considers advanced AI and related IP to be strategic, protected assets, regardless of where the company is now registered.
So let's wrap this deep dive up. We've seen the AI build-out accelerate with blistering speed. It's driving record profits, forcing a market cap shuffle in the Magnificent Seven, and requiring this massive commitment of capital.
And this whole technological future is being built against a backdrop of really heightened geopolitical uncertainty. We have the U.S. gaining unprecedented control over Venezuelan oil, a potential $1.5 trillion boost in defense spending, and all this regulatory friction.
Which brings us to a final provocative thought.
It does. This raises a really important and, I think, unavoidable question for all of us to consider, given the immense and growing energy requirements of this expanding AI ecosystem, the data centers, the robots, and you couple that with community pushback like we saw with that Microsoft project in Michigan.
And the devastating copper bottleneck you mentioned.
And that bottleneck. How long until the sheer combined demand from the dream military and the AI boom forces a fundamental and probably painful rethinking of infrastructure priority and resource allocation globally? It seems like the physical limits of our world might be the ultimate ceiling on this digital revolution.
We'll see you all tomorrow morning with new headlines from major financial magazines.